Okay, so I want to just demonstrate what I was just talking about and show you like how does that work as far as the numbers are concerned. So I guess we could start by making some of these numbers a little bit bigger so everyone can see them better, huh? All right, let's do that. Okay, so let's just say I'm just going to use round numbers to demonstrate it. So let's say that there's a property where the annual, everything in multifamily is done based on an annual basis. So let's say the annual income on the property is 100,000. Okay, and then let's say that the operating expenses are 60,000. Okay, so that would mean that the net operating income, the NOI, is $40,000. Now let's say that there was a market cap rate that was 7%, meaning in that market, that is the cap rate that most properties end up being purchased for. Anyway, I won't go to the details on that other than what we covered in the last video, but I'll show you how some different cap rates, like different markets, how that impacts the numbers a little bit later in this demonstration. Okay, so we would see that if a property has $100,000 of income coming in, revenue, and 60,000 of expense going out, the net operating income at $40,000. If the market had a 7% cap rate, then the property value would be $571,000 and change. Okay, and it's kind of like if you think of ARV in relation to single family homes, it's almost like ARV is related to the cap rate. Okay, that's the most similar thing. It's the return that people are willing to invest in that market at. So if we had an opportunity, let's just say, to increase the revenues of the property by 15% over the course of a year. Let's say we did nothing with the expenses. All we did was increase the revenue by 15%, by $15,000 a year. Let's look at what does that do to the value of the property. So if we change the revenue to 115,000 and hit enter, holy Bob, look what happened, right? The value of the property went up to $785,000. Now that's crazy. If you think about it, what is $15,000 divided by 12? $1,250 a month. So if you can figure out, which, if you're looking to passively invest, it wouldn't be you, but if you're looking to actively invest, if you can figure out how to add $1,250 of revenue to the property, in this particular case, it has a huge impact on the value of the property, right? So 15,000 seems like a bigger number, but when you break it down to on a monthly basis, if you're talking about a 12-unit property and you increase the rents by $100 a month, because let's say they were under market, which is commonly the case when we buy these, if all you did is bring it up to market and it was only $100 a month difference, look what a huge difference that made. It was over $200,000 in value that was added, right? And then let me show you also, let's put it back to 100,000. Let's say that with the expenses being $60,000, and let's say we were like, oh, interesting, the utilities aren't paid by the tenants at all. Let's go ahead and institute a utility reimbursement plan. And that's not something when you close on it day one, it's not like you can immediately make these changes. You have to wait until people's leases come up. And that is up to the operating partners to evaluate all of that prior to closing to create the business plan. Because it might be that, okay, 4 of the leases come up 3 months from closing. Well, those would be the first ones that we're going to institute this with. And as other leases come up, that's when we'll make those changes. But let's just say over the course of a year, we were able to decrease the utility expense by, let's just say $12,000. Let's say it's $1,000 a month times 12 months, so it's $12,000. That means our expenses would go from $60,000 a year to $48,000. So let's put that in. Okay, so now our net operating income is $52,000. And look at what happened to the value of the property. It went from $571,000 to $742,000. So that's the whole idea with value add and why we like there to be value add opportunities. Now, for a long time, it was very, very popular to have value add be the primary and only exit strategy that most investors would focus on, even to the point where they would be willing to accept negative cash flow for a period of time because there was such a good upside. That was a great strategy for a long time while interest rates were low. The challenge is when you get into a higher interest rate environment like we are in right now, you really don't want to put all of your eggs in the basket of future appreciation, because especially when the market is moving, if the values, if the cap rates change or the values go down, like, you don't want to be tied into that being your only exit strategy. So that is why, for us in the way that we run our business, especially right now, we always look for deals that are already stabilized, but also have a value add component. The cash flow with the stabilized part is that makes us be able to sleep at night. That makes us feel safe. The value add opportunities is what get us excited about, let's keep making this property better and better and better, because we're all going to make more money. So we really believe that having both is the ideal situation. And even for the past several years, that would have been an ideal situation. It's just that the bigger opportunity was in value add. So we were a lot more willing to take no cash flow or negative cash flow or very low cash flow for a period of time because of how big the upside was. But now that things are a little bit more, interest rates are higher, the deals are a little bit harder to pencil with those higher interest rates, we make sure from day one with our financing in place that there is already cash flow coming in and that we also have the opportunity to increase it. All right, the other thing I want to show you, let me put this back to $60,000 just so we're dealing with the same numbers. The other thing, and this is a question that you will want to ask when you're looking at a deal to invest in. But the cap rate, you want to ask the question of, well, when you're projecting your numbers at the exit of the property, the sale of the property, what is the cap rate that you're using and what is the basis for that? And the reason you want to ask that question is the cap rate is going to absolutely impact the value of the property. So for example, if we were in a market where the investors were like, you know what, we will buy properties if they'll give us a 6% return. For those of you who are a little bit more knowledgeable in this area, these are not technical definitions. And I know that I'm not explaining it based on the technical definition, but I think this will land better with people. So if you're like, wait, that's not the exact definition, I know. But the exact definition tends to make people's brains explode. So let's stick to what makes sense for people to connect the dots. But let's just say that we're in a market now, people are willing to buy a property that gives a 6% return. All right. So let's say that the market cap rate became 6%. Then the value of the property is going to change from $571,000 to $666,667. Okay. So by the cap rate going down, the value goes up. If we were in a market that was a 5% cap rate market, meaning people are willing to buy a property with only a 5% return on investment, the value goes up to $800,000. So the purpose of me showing you this is for you to understand that cap rate is a very significant driver of the value of the property, which if you're making your investment decision based on what the upside is going to be, it's important that you know what cap rate is and that you can ask the operators of the property when they underwrote the deal, what is the cap rate that they're using, based on. So let's just put it the other way. Let's put it back to 7%, right? So we see the property value is $571,000. And I know these numbers are very, very small. The chances are the deals you're looking at have much larger numbers, but we'll keep it simple. Let's say that we were in a market where the cap rate was 8%. So investors are only willing to invest there if they can get an 8% return on their money. What does that do to the value? We change it to 8%. Now the property value went from $571,000 down to only $500,000. Right. So that's why it's important. I mean, it's important for you to know if there's a difference of $71,000, and that's on a small property. So you get into larger and larger properties, that difference in cap rate can make a massive difference in what the value is going to be. Now, here's the thing. Nobody can ever truly know what the market cap rate is going to be at any point in time in the future. So what you're looking at is in asking like the operations team, the underwriting team, what is the cap rate right now? What is the market cap rate right now? And what is the market cap rate that you're using to project the value of the property at sale? And what you want to do is just listen for, are they being conservative? Because if they say, well, the market cap rate right now is 7%, but we really think over the next 5 years, the market's going to get way better, not based on anything, we just think the market's going to get better. So we're using a 7% or a 6% cap rate to project the value. That would cause you red flags because it's not based on any kind of data. And in fact, normally what you'll see when you know that there's someone being conservative is they'll take the current market cap rate and the exit cap rate is actually a little bit higher than the current market cap rate. The reality is it might be lower, which is great. It means everybody's going to make more money, but being conservative would be putting in a market cap rate that's a little bit higher. So it assumes that the market's going to be a little bit softer at the time you sell, and you're basing all your numbers on that. So if you hit that, cool, that's what you were expecting anyway. If the market gets better, or if you do better as far as how you turn the property around or how you increase the NOI, everybody makes more money. And if you're dealing with a conservative and responsible operator, that's ultimately what they're doing. They're always going to try to under promise and over deliver. But there's a fine line there. We don't want to get so crazy in our under promising that the deal is now, it's not even interesting because the numbers are so low. So it's like finding this middle ground where this is realistic. This is a realistic business plan. But sometimes we will leave out some of the opportunities out of our initial projections, because what if we can't do all of them? We can do one, but not the other two. And sometimes you don't know that until you actually buy the property. So the idea always is to be conservative in our underwriting so that when we get into the project, we want to be able to give our investors, or if you're on the operation side, you want to give your investors what you expected. And ideally, you want to be able to have their returns be even higher. And that's one thing that you can do by being conservative with using your cap rate, and also in what you're planning to do with your business plan. Anyway, I hope that helps. In the next video, we're going to talk a little bit more about due diligence, just at a high level, so you understand what it is that an operator is doing and should be doing when they're going into a deal and making an investment decision.